All right, the recording started. This is gonna be a Good Friday lesson for VIP room and probably unlisted video until I get something worked out that I like for the public. But for the meantime, it's gonna be very open minded. So we're gonna have people from the VIP room asking questions and whatnot. And so let's get started. Let's get started. It's a cool Friday morning. Market is closed, and we can focus on the market price action. I mean, on the lesson instead of the market price action. You know that I remember yesterday, last trading session, we I was trying to explain something in the middle, and I was in a position in its car. I'm like, in my mind, I'm like, is this working? Is this not working? Should I put a stop loss? Is this gonna run? And then I'm trying to answer questions, so it's kind of hard. Right now, the market is closed, so it's perfect, right? It's perfect. And so yeah, uh, let's get started. The I think this is the list. The that I wanna go over right here, right? Um, I think that this is just enough that what we need, right? Um, we're gonna go over overall TA, which is support resistances, and this is stuff that you guys know already. We're just gonna go over it, so like a refreshing thing, and to understand why it makes a part of it, part of the trading, you know. Support resistances, trend lines, fib retracements and extensions, simple and exponential moving averages, compression and expansion, and market structure. In fact, all this stuff right here is some resources, but it's good to have a lesson, right? Especially an open mic or open question lesson. We're gonna talk about managing a position once you're in. We're gonna talk about not you in, getting in and managing the position. So what I, what constitute a perfect entry, the not so perfect entry, the straight up bad entry, adding and reducing size, the psychological aspect on managing a trade, and position size, also understanding risk and accept the risk, which is also part of the psychology. But it's like its own. I like to think like it's a separate thing, which is if you once I go over it, like if you understand this, you will uh, tend to paper hand less and take stuff to profit targets, which I believe um, the people that we have here, I mean, our usual Jerry, Pulpari, and Remy, I know that they understand. I think they understand. Um, we had another member, I guess. I'm not gonna say names, I guess, but some other members just do not understand the risk, and that tends to, do a lot of questioning and all that. And we're gonna go over understanding options, which is basically the Greeks, and that's gonna help for people that, for example, Jerry, that you swing a lot, right? So it's not it's good to understand it for weekly options and scalp trading, but it's not necessarily needed. You can actually get away without knowing. You just got to know that calls, if the stock goes up, calls gonna go up, and if stocks goes down, puts are gonna go up, and vice versa, right? But the understanding
Yes,
the option Greeks,
as much as I understand, and then buying as close to the price as possible.
well, it is good to understand, to know the extent of what something can decay to, what the potential gain. You can there's no way you can exactly know what a option price contract is gonna be in the future, but uh, you can have an estimate, an idea, right? Because there's a lot of factors on the Greeks that do not are not a constant. There's the stuff that is constant. There's stuff that is not constant. That it changes with the market, with how the market is moving. So, all right, we're gonna go over that. And if I think about something else, I'll add it. This is what I came up with, and I think it's good enough. We actually could go over some stuff that is like looking at option flow and all that stuff, but I think we're gonna leave that for another day. Um, And actually, I mean, I have a lot of stuff. If you guys let me know right now, I have this lessons of marketing journal. So this is basically to trade a spy, or yeah, basically to trade spy. Which is I think to me is good to know context, even though you can get away with only price action on spy. You know, so if you guys are interested, let me know and I'll add that to today because I think it's important. I trade a lot of futures. If you guys gonna join futures, this is gonna be good. And
I think learning how to trade spy is like bread and butter. Like if you learn how to trade spy well, like you can make a living off it. So this is like a perfect introductory, to be honest.
yeah, and actually knowing what happens kind of under the hood or having context of why spy is moving the way it is helps you sometimes to actually not even to avoid spy, to not even trade it that day and actually look for better setups on other tickers, right? Because I just the opportunity may not be there to have some kind of edge, some you're gonna be on a range day or something like that. Of course, everything that you see in the market, I mean, it's hard to predict too. Everything's like after the fact, but we can have an idea, right? We can have an idea. Uh, let's do what do I call this under the understanding the S&P 500. And by the way, like you can get away by only looking at TA on SPY and all that, right? You can get away with it, but it makes to like I said, it does help you to have context, So let's get started. Um, Actually, I know I thought about something else. Setting up a watch list. All right. So this is now what we're looking at right here. Any questions? All right, no questions. Okay, we're gonna keep going. So as per this, we're gonna go over support resistances. This is I think this is a very simple matter, but it is a type of um there's a saying in Spanish, a ojo de buen cubero, which means like it's like an art, for like it's for a good eye. You know what I mean? Like it's just there's auto tools to get support and resistances, but what constitutes one is whenever your eye sees something, right? Whenever you can actually tell that there's some action on some levels, and it's basically peaks, basically where the price action ends and begins. Understand that they tend to be areas and not an exact price point. I have this ability to sometimes pick the exact point of stuff. So it's just sometimes it's very simple. I'll give you an example right here. Just by looking at this chart and looking at something, what there's a ton of support resistances. I mean, you can just put lines here, 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 any peak, right? But you have to put like ranking system to that kind of stuff, right? A ranking system to that something is strong or not. You know. So right where I have my line, I see something right here, right? I know this is the peak right here. I know this is a peak right here. I know it's going a little higher, but this is the close and the open of this one, so it still counts. It's still good. You see a couple of peaks right here. We see this peak right here, and we see this price action right here. So you can actually tell that this is gonna be like an area, but we'll pick up a point, where we think this is gonna be a good area, and we're just gonna go by this, right? We know that this went a little deeper, but like I said, we understand this is an area. If you go by this one, you'll get more of the closer to this peak or whatnot, but you get closer to this. You see all this, and that's gonna be like I'm gonna actually put like a different
Wait,
level.
wait, wait! You're going too fast.
No, tell me. Ask me.
Okay, so you said something about peaks. What do you mean? I don't understand.
Well, peaks and valleys. This is what we. There's a term that's called peaks and valleys. So, where's my presentation? All right. Um, where can I start a new slide? All right. Um, come on, change my background to something. All right. So for support resistances, you're gonna be you're gonna be looking at it like if they're peaks and valleys. Is that the right word? Valleys? Is that how you type it? I hope it is.
Yeah, yeah.
If not, I'll look like an idiot. But basically, that's what you're looking at. So peaks are gonna be stuff that it's at the highest, something like that, where it peaked out right here, and valleys are is where it bottom and it start going back up, right? So a good support resistance area, and we're not, and why that's why we call it support and resistance. It's a dynamic level. If you're underneath, it's a resistance. If you're above it, it's a hold on.
Support.
Sorry, I had to deal with something. Um, so um, so when you're underneath, it's gonna be color resistance, and when you're above it, it's gonna be color support, and they are both because you should treat it as such, right? What and there's a good saying, that um, where there's once was support, and then what was support is resistance, or what was resistance is support. There's just a little saying that people use, so it means where are you situated on the chart in regards of that, right? um let's look at this one right here. Does that answer your question, Remy, so I can move forward?
Yeah, peaks and valleys. Okay, I got that.
Yes.
I just didn't understand where to see them because like look
Okay.
if
This
like
is look at this next example right here. You see this valley right here. I know the market went a little lower right here. In fact, it went lower right here, right here. Right? So the valleys are getting bigger, but on the daily perspective, you had a jump right here, right? I know it got somewhere invalid right here. I mean, not invalid, but I mean the market's not gonna stay in the same place at all times, right? So you have a drop right here, and you end up having the peak of before the drop started right here. You have a peak before a pullback. You have a peak right here before a pullback. You have a peak right here before a pullback. So that's, if I see just by looking at the chart, right? It's like immediately for me like a strong level. I'm gonna put it in yellow. Like usually, if you see my charts, red is gonna be a support resistance, and yellow is also gonna be a support resistance, but at rank higher. It's a stronger. It has more strength at other levels. Okay, so this is only for you to. I mean, there's auto tools. Jerry uses an auto tool. I dislike auto tools because it doesn't really. I think there's no better thing than just seeing on your eyes.
Yeah, the article kind of gives you like an estimate. Again, those are, everyone's gonna say that like everyone sees like different zones. They all approximation, so they kind of help my eye in a sense.
Yeah,
So even though it's like auto, I still have like in my head it's like somewhere close to that area, but I might have another area. I don't know. It just helps me.
yeah. No, I understand I think that I think the it's best to draw yourself. So, I mean, just think about it. It doesn't
Yes,
it doesn't
maybe
take.
on a chart that like I trade constantly, like on SPY for example, I do have those areas. But on charts that I don't look all the time, I will just use the auto thingy because I mean, I don't look at that stock all the time, so it doesn't make, yeah, kind of like that.
Yeah, and I think like it just doesn't take long, guys. I do think that, I mean, I'm not gonna. I think it doesn't take long for me because it's just I've been doing it for a while, and
Yeah, I was about to say it doesn't take long. You have experience and you can spot them right away. But if you're just like a beginner, it takes a bit.
Yeah, it takes a bit. I will say that's why I want you to guys to, if you have an auto tool on support resistances, get rid of it. So you can get practice on, right? I know you may even ignore it, maybe not even pay attention to it, but I will say that not only you're gonna get better support resistances on your with your own eyes, but also you're gonna um, you're gonna get practice on, right? And you're just gonna go straight up quick, straight up quick into it. Let's look at where my mouse is right now. You see all these peaks, peaks. There's the peak was not that well right here. Actually, we're gonna add another years right here. All right. So we just look at this level right here. You see all these peak valleys right here, valley. You know, that this constitutes a level. An important level on the future. Right here. So I'm just going by the ones that I think are best support resistance because there's a ton in the middle, right? I mean, there's a ton. It's just I'm just going by what I think is best, right? Even though there's a little peak, you can see actually where the candles close, right? This one closed right, almost right on it, and this one opened almost right on it, and we take them as areas all the time, guys, all the time. Why do we? And this is gonna go with about market structure, right? Market structure indicates that liquidity grabs are usually a poke or a break of a resistance or a support, right? That's why we don't try to go sometimes with like longing something. Like if we get a poke out of a level, we have to be taking profits and stuff like that, right? Because the market tends to just do that, right? And it punishes a lot of people that are breakout traders, that are, okay, it broke this level, let me buy it, and next thing you know it dropped, right? So we'll talk about market structure, but I just want you to understand why there's zones and not just a price point to the penny, right? If you by the way, stats, if you want to add something, jump in. So so that's what I have, right? We also have to get supports, even though, like, let's say that you think the market is going higher. That's your assessment. Oh, the market's gonna go higher, it's doing a bull flag, it's breaking to the upside, blah blah blah. You still have
Quick
to go.
question.
Go ahead. Go
Quick
ahead.
question. Can you show a bull flag and a bear flag to me? I mean,
Ye-
I read about it, but it'd be nice to get it explained rather than just read.
Yeah, that's actually gonna go with the fee retracements part, and I'll go over that. And at this moment, like I said, I was just gonna say that if you're looking for this to trade higher, that's your assessment, right? And you start drawing your resistances. Okay, this is gonna go higher, so let me see where I can go. I join in right now, and I start taking profits. That's cool and dandy, but the market's very unpredictable. Anything can happen. You have to know where your other side is, right? Your supports are at and everything. So I recommend you guys to chart below where you at, just in case, so that's what I'm saying. Like if you are right here, you're looking to go right here. Okay, that's cool and dandy. But you also where if it drops, where can it drop? Where can I buy, right? Where are my peaks and valleys? Look at this peak right here. Look at this peak right here. Here. That's a lot of like points right here for me to think that this is a good level, right? Right here, right? Does it make sense? And moving on, let's go for another one. Let's look at this peak right here, which aligns with this peaks right here. If you go to the left, this was another one right here, but it's a little lower. Let me see what I like better right here. This one, I like this one better. So this is gonna be a good area right here, right? So it's good to have like different levels, even though you think it's gonna trade higher. For either your next trades, your next if you flip to short, where you're gonna take it to, all the stuff, right? Um, yeah. So we'll go over shapes and forms, patterns and stuff. We'll see why they work and why they're not. They don't work. Um, I guess another thing that I should add is about, indicators, right? So just gonna add this. I just because I'm a very guy that I'm a guy that goes against indicators, but we'll talk about him. So that's what we have. So I think we can move on from support resistances. We're gonna treat them as areas, and we're just gonna look at certain price action in between them. The stuff doesn't go up and down on the same on one point to the next. You know how some people are like, oh, if this level goes, then I'm gonna see this other level, right? I mean, like if this level goes, I'm gonna see this level. But it's just I don't think it's just a good assessment, right? Because I know, like, let's look at this hourly candle right here. Let's say that yes, it went once this level gave up, it went from here even deeper, right? But let's say this is your target, you went here, so you made money from here to here. Now, it wasn't like that situation. It looks like that in hindsight 2020, but in reality, this one actually lost the level right here, right? And in fact, it lost the level right here, and it did not. I mean, it lost the level right here, lost the level right here, right here, right here, and it did not came into fruition until until later. So I think it's a misconception to think that you from one level you're gonna head to the next one. You still gotta monitor and look at price action. That instead of just going by level by level. You know, it's just that's how some people trade. I'm not gonna name people, but that's how some people trade. And in fact, like, let's say that you recognize this is a support resistance, right? And sometimes you'll take a long, see how far it gets you, and sometimes you'll take a short. You'll get some points of it, but you still wanna be very aware that you may not get the next level. Just how the market works, right? I'm not go from this level all the way over here. And look at this hourly where it stopped. So that's why we have those. We gotta keep an eye on those peaks and valleys, right? So it makes sense right here. Any questions, guys, about support resistances? No? Moving on. Next, what is next? We're gonna go over trend lines. I think trend lines should be part of your tool belt for trading, but don't make any trading decision based on it. So like if your sole reason of something is because it broke a trend line or is at a trend line, so you may go long or short into a trend line. I think that you should not base a trading decision on it. And I know that because the market sometimes it may look like it's perfectly holding a trend line, right? But it just doesn't work that way. It just doesn't work that way, and especially on this market, the whole I think the whole premise of this possible bear market being over is that it broke this trend line right here. If you notice right here, if this goes about aligning, trend lines are about aligning peaks that you see on not on a horizontal matter. So something like this. This is a good example. You only get to know there's a trend line once you have two peaks of them. If you have two, you have constituted a trend line. So you're usually gonna draw your trend line like this. You have two, and then you're gonna extend it to the right, and this is basically your point, right? So when the market came up to this point, it was like, I guess in hindsight, very easy to say, let's short the market. Let's short the market, so you can basically get a good shorting position if you come to it. Now, people actually wait for breaks of the trend line to get on the other side of the trade, but I like to think that if you have a good chance of a trend line, um, you may you may take the side of rejection, right? I mean, we just that it's just. I mean, in hindsight, this was a very good level to short. Look how many points it got all the way over here, right? From here to here. So it's just it was a big one. This is a weekly chart. Um, so the reason I want you to, I know this isn't like, oh man, I'm gonna start using only trend lines. Look at this one. It gave you a lot of points from here to here. But let me give you an example where it just doesn't work, right? Let's look at, for example, this bottom right here on the weekly to this bottom on the weekly. Let's do a trend line from here to here. Let's say that this is doing like a broader information. We're gonna extend it to the right, and we're gonna see that. I mean, this didn't do shit right here. This didn't do shit right here. You know, nothing. That was not good. You know. In fact, if you go from this weekly to this weekly, let's go. Let's see if we can spot something right here. We're gonna extend it to the right. There was something to do right here. It was not perfect, but let me tell you that you will still have seen some kind of possible long into the trend line because of this. And I remember actually this very vividly. I was getting ready to long at this trend line, you know. I was ready to go long at this trend line, but the market didn't give it to me by a few points. You know, by a few points. I remember this very much. You know, I was looking for a little bit below 3,800 or so for this. It just didn't give it to me. You know, so you have to be a little bit flexible with trend lines. You know, they're not an exact thing, and you know, we might keep something in the future. You know, let's say the market actually crashes or something. You know, that it has a big leg down. You know, I'll be looking at something that connects this right here. Oops, I didn't mean to do that. Extend to the right. You know, let's say that I'll keep this right here. Let's say that the market does come down a lot, and it looks like the world is ending. You know, I would like to be short in that move, and hopefully I'll take some position into this point right here. We don't know that, right? I mean, could the market very well not do that, right? Or for example, let's say that you think the market is on an uptrend. You already see that we place a bottom right here, and we place a bottom right here. So it's good to have a trend line from year to year. Now, do you solely base a trade decision on that? I don't think so. You know, I don't think so because, like I said, there's gonna be a lot of points where the market just doesn't respect anything. Let's talk about an example. This one that doesn't make sense, right? This one to this one, it was already a peak. It got. Let's say you start adjusting your trend line, right? Because it just doesn't align with this one right here. It doesn't align with this one right here. So just go by the latest one. After when you print this candle, this is the latest one that you see. You extend this to the right, and this is gonna be your trend line right here. Let's go down to the weekly. Let's actually just put this. That's the weekly. I'm sorry. This is gonna put a different line right here so we can recognize this line. And we're gonna go with the daily. Was there trading? I don't think there was any. Oops, didn't know. Let's go. Yeah. Look, there was nothing to be done right here. There was a day that it had a bounce. There was a possible a good long entry right here, right? Just a 1 day bounce right here, but it didn't give you much. So that's why I want you to see them as in a very, I guess, a very dynamic way to look at the market that is not, you know, do not make a trade just because of trend line. That's all I gotta say. I think like the more points that you touch a trend line. So let's say that you only touch two. That starts the trend. A third verifies the trend. Anything extra, it is making the trend stronger, but um, the more some stuff that even support resistances, the stuff that gets rejection, at some point somebody's gonna open the door, right? The odds decrease, statistically they decrease every time you're hitting, that this is gonna hold and at some point it's gonna break up, or vice versa, hitting, it's gonna break down. You know, so it's just the odds of something working nicely. You know, for you want to see something that comes up to, let's say, a resistance. If you want to short it, to reject that once and do a leg down like this. You don't wanna you don't wanna see like a consolidation pattern. Can it still drop? Yes, it can make a consolidation and then drop later, but the odds, like, they're working against you when that happens. They're just not in your favor. As time goes on, right? You just gotta imagine, sellers, like, psychologically speaking, sellers are gonna get tired at some point. Just by being on that area. So we have that. Okay. Um, we're gonna get rid of this. So I think, any questions about trend lines or how to? Yeah, I think that's it. I think another trade setup that you can have with trend lines, it's basically what people call like a break and retest. So kind of like the market breaks it and then has a retest of it. You can try a long. I don't think this one. I mean, it looks like it held, right. It held the trend line break, but it went deeper. I mean, you would like to see an exact touch, but just basically like what became a resistance is now support, so you can make like a break retest. And I think it works very well on individual stocks, and some individual stocks. They tend to respect that kind of logic a lot of times. The market, the S&P 500, is a little harder than that, you know. And and you can constitute the stuff like this, something like this as a bear trap, because bears, um, look, this breaking is bullish right here. This breaking is bullish because it broke the trend line. But this right here going back underneath is not bullish. It should have held it right here like it did on this weekly with this weekly candle. So later on, if you after this candle, only after this candle, that this became a bear trap.
Wait. Huh. So you said, can you say that one more time? Because I didn't quite
Okay,
understand
so
like what you meant. Like, oh, like this, this is a bear trap now.
there's
Like it
there's
should.
there's things that are bear traps and bull traps, and basically they are failed breakouts, either on support and resistances or trend lines. And we're gonna use this trend line as an example. So this this is in the eyes of the two factions right here as bullish. There's no question about it. Sellers will still be hanging around the idea. The perma bears will still be hanging around the idea that the market will still drop, regardless of what it did right here. So they'll be looking to go back inside this, what was rejection earlier. Even though this was already played out, it already broke out and everything, bears will like to see this right here again. Do they get it? Yes, they get it right here. On this little bitty candle, they get it right here. Not only that, but they get a weekly candle close below it. That's a sell signal, because if you look at this action, this is basically a bull trap on the perception that this is gonna drop below this. Now, what you have next is a bear trap. So, and this is because whatever doesn't materialize to the one side, it goes harder to the other side, if it makes sense. So basically, right here, should the market have come, now that it went back in and it validated this breakout, should it just kept going lower? Did it do it? No, it didn't do it. And that only after the next weekly candle that it closed above it. That didn't have the. You can imagine, right? Like, try to forget this 1, 2, 3, 4, 5 candles right here. Try to forget this 5 candles. Try to forget them. Try to think like this is the only thing that you see. I don't know if I can I guess if I can put it like this, right? You're looking at the market like I'm sorry, just no, it doesn't let me. Yeah, right here. Okay, try to think like you're only seeing this chart right here. You know, so you kept this trend line. You're not gonna erase it because it might work in the future, whatever. And you see this right here. Now, I don't think this is completely bearish because on the perspective of market structure, which I'll talk a little bit, this low is deeper than this right here, and you're not bearish until you actually break this low. But this is like you can call it the first step. So what you can imagine, what another seller would expect after this candle is that the next weekly candle does not pass this trend line and makes a lower low right here and invalidates this low, so they can keep going with the sell, right, with the bear thesis. Now what you have on the next weekly candle, it's this. Will that make you feel like you should be still selling the market, knowing that you should have got this, you broke and closed below, you should have got continuation of this? No. This is when you can, once this weekly candle close above this again, this is why you can call it a bear trap right here.
So a bear trap is like when you look at that candle and it what is it? There's no continuation, right? You said that
Yeah.
didn't go up, right? So it invalidated the breakout, but then it doesn't go down all the way to, I guess, the bottom,
Yeah, the
right?
3800 right here.
And then it goes back up, then it's a bear trap,
Yeah.
and then that's a good area to
Well,
long at that.
not it's not a good area to long per se, but because we'll look at the next weekly candle. This is the next weekly candle. So the next weekly candle, I mean, you don't straight up just long right here. You be longer right here. Yes, you're gonna be right here, but you're also gonna experience this, right? So you still have to do your homework in between, depending on the time frame that you're looking at. This is a weekly candle. This is a weekly candle. So you go down to the daily, you do your assessment and everything, and you look for a place for longs. But you from this, just by this, you're not gonna formulate a trade on this, right? You're not just go straight up. Oh, this is the bears are trapped because they didn't get continuation. I'm gonna long it. No, you're not gonna go straight into jump into conclusions like that. But you can. What you can do is think of the next trades as longs, gonna have because you can long and short in between whatever the opportunity presents, but the longs are gonna yield you more profits. There's gonna be where the is where the edge is gonna be. You know what I mean? Does it make sense?
Yes.
Yes. So it's just you're just gonna get more out of the once you know that there's like a bear trap or bull trap or something there you can still constitute the next trades to be have a possible more edge to the upside, right? So we're actually gonna look at this on the daily. So whenever this happened, the weekly candle that closed below it was this one right here. I think this is a Friday. Let me see which one is a Friday. This one. This one is the weekly candle where it closed right here. This one right here. So the next weekly candle is 1, 2, 3, 4, 5 right here, right? This is where you look for you already know by this point that the market is we actually caught along on this. This is where I think it was something on the base of that the market, it looks like, one of my setups, and we're gonna go over the EMAs, is shorting if you're underneath, shorting the daily 20. If you're above, longing the daily 20, right? So if you look at this was a nice short, but should you continue shorting because of this rejection, thinking that it's gonna drop lower? No, because we already have an assessment with this weekly candle closing like this. This is the Friday close, and you know that it didn't close below the trend line. It's still it's not as bearish because you should have had bearish continuation. So what happens next is that I look for a long entry, and this is gonna go on the fifth retracement class, which it comes from this not the class, I'm sorry, the next lesson, which when you anchor a retracement, you start looking for your long entries. It just doesn't surprise me. We actually were looking for longs in this area, which ended up playing out, for a break of the daily 20, so I know I'm speaking in hindsight, but I think I can show you some trades that I did based on this. I was looking for longs on this area, and if you look at past analysis, I think it was there on the analysis that we were looking for longs on this area for the very same reason. Look at the weekly candle, did not get continuation to the downside, constitutes a bear trap. So you start looking for a higher low on the market, which ends up being a higher low right here, right? And everything just starts doing a series of higher lows, higher highs. This went deeper, so um, looking for higher lows, higher highs, and you start looking at the market that way. You start looking at other clues to get in. So I guess that was not part of it, but that's a lot of the premise of the bull traps and bear traps. And let me tell you, I I am under the belief, I could be very well wrong, but the large candles, like let's say like this one, or like this ones, are made by people being on the wrong side of the market. You know, when something has like a big breakout, intraday, something, let's say, something like this. Let's look at this action right here that went like this, or like this candle right here. Just this candle right here. So this is the 15-minute chart on ES on the Thursday session. So if you look at this on the this big candle like this, I can tell you that yes, there are traders that will look for breakouts. Let's go down to a 5 minute actually. There's traders that once it breaks a level, okay, I'm buying. Yes, but most of the in positions that are initiating on the market are done by buying the bid, setting a bid. Being a buyer, a lot of the times, if you believe something's gonna go up, is going and set the bid, which is being a buyer of a lower price than what it currently is. Where you think it's a good price to buy, so you can sell it even higher, right? Being a breakout trader, it means that you're buying the ask. You're gonna buy in with market orders. So you're gonna buy the next available ask. So you can get in, and essentially, most of the people that are buying on market orders, let's say, if people are buying in the bid to go long, who are the people that mostly hit the ask of market orders to buy? That will be shorts. That's how you create your short squeeze. That people that want to get out of the market at any moment, don't care the price, right? You're looking to get a good price. You're looking to sell a good price. When you're wrong, you just want to get the hell out. And those are the a lot of the big candles. That a lot of the big moves. Is that people are caught in the wrong level. You know, and the market will tend to liquidate, or to the downside or to the upside of this market, right? So I'll give you an example right here. This is the overnight, right? You essentially place this drop and recovery right here. So people are along in the market throughout this whole run up right here are basically you're gonna have this run up which eliminated the shorts right here, and you're gonna have a big build up on longs right here that are long and long. Then the trend starts reversing. Why do we have this candle like this, guys? It's basically, this is because the market open, right? The market open, and we're gonna have higher volume. But not only that, but longs overnight will actually set their stop loss somewhere like, okay, I think the overnight lows, which are actually this ones right here. But let's say gonna look at this and set their stop loss right here. Stops are right here, and the stops are below this level right here. Once you go below all that, the longs that we're building this whole session right here, they're gonna start getting out. It's called a liquidation break. I think it shows a lot on market profile stats. It's very aware, and stuff like that. Where longs are building up to this area, and you can think of it like the most logical place for a long to place a stop loss will be something like this, right? So once you go below it, it's like market orders hitting, to get out, right? And also shorts jumping in. Now what happens with this short right here? Oops, I'm sorry. What happens with this short right here, right? Traders that are joining shorts right here, they start placing their stop loss a little bit above those candles right here, and once you start running them over, the market's gonna just have those spikes up, and start getting traction to the other side. So a lot of the yeah. So I was saying, a lot of the moves that are on that are larger, will tend to be people on the wrong side of the trade. That's what people. That's what it will be. Closing trades instead of initiating trades. Hope that makes sense. There's also let's see if I can spot a bull trap on a bear trap on the hourly. Let's see, because I talked about it on trend lines, but support resistances, they happen a lot as well. I don't use that methodology. One of the traders that I follow very closely does that. The bull trap and a bear trap and all that. So let's just go down. Let's look at another stock. Actually, let's go to Tesla. Okay. Let's see. Ignore my lines for now. Like, no, I like Tesla better because the ES is a little trickier on the bull traps and bear traps in that regard. So okay, let's go to a clean. All right. Let's see if we can spot a support resistance that it's important on Tesla. Kind of like this. Look at this right here. This is a good level. Look at this. Look at this low right here, guys. Look at this low, and look at this other low right here. That's basically a main support right here, just by drawing resistance support on the hourly, right? We know that Tesla actually held this on pre-market, right? It actually held this on the hourly the next day. But what happens on Tesla right here? You have a candle close and price action, two hourly candles close below it. Is that not confirmation? There's actually an hourly candle close below it right here on this level, on this one right here on pre-market. Is this not confirmation that the level fell and is now heading down for Tesla? It is, right? But what happens next? If you have an hourly candle that is close above it like this action right here has become a bull trap right here. Does it make sense? But you only know that this was a bear trap. I'm sorry, bear trap after this hourly candle has been placed because it closed above it. The Tesla was supposed, once it broke, it's supposed to use it as resistance, which it did. Did you see this little wick? It stopped right here and continue its path down, right? But it just didn't, and in fact it came to another support right here. But in the regards of this support breaking, it becomes a bear trap. Does that make sense? Alexa,
Yeah, it's very clear.
dismiss. God damn, I have a lot of reminders now.
Why did
You
you pair of
can you
sequins
explain that one more time?
to catch up with the
bull
sound
trap
of run?
scenario. So how do you So you're saying that it took an hour to develop, right? Um, is there is there a shorter time frame or
Well,
yeah?
yes, the I'm gonna let's actually jump into market structure so we can understand that.
Okay.
Okay, so you basically time frame time frame makes sense, and you're gonna put a strength on certain time frames depending on the on the higher the time frame you're setting the setup at, meaning that anything at the 1 minute works just as anything on the daily or weekly works. Anything, patterns, fibs, EMAs, retracements, whatever, support, resistances, everything's gonna work on the 1 minute. But your strength of that level, or strength of that support, the strength of that fib, the strength of that EMA is gonna be weaker the lower the time frame you're in, and stronger the higher the time frame you're in. So anything that constitutes a confirmation, because you can confirm anything even to the 1 minute, but does it does is it let's look at this day. This is 313. Is this too far up? No. It's just gonna look at this on the this is the hourly. So we can look at this on the 30 minutes. We already know what it looks like. And we're gonna go down to how many days was that earlier? 30 days? Yeah. So let's go down to the 30 minutes. The 30 minutes also shows, that is this hour, this candle right here that invalidates this. Because they already try to reject here and here, right? So the 30 minutes already telling us, right there. Let's go down to a 15 minute. Oh, give me 30 days again. This right here. So the 15 minute tells me right here, way before this candle, that the 30 minute actually was up to here, right? That's when it closes. So the 15 minute actually tells me before. If you notice, there's a lot of 15-minute rejections right here, and none of this is confirming that it's gonna go higher, but this one does. This close right here does, and that's what happens later, right? Let's go down to the 10-minute. The 10-minute shows part of the 15-minute candle that was right here. There was, if you notice, let's say that you treat this level as a exact place, you actually had confirmation to the upside on this candle on the 10-minute. Does it go up from there? Doesn't, right? So you can tell just by hindsight and this at this point right now that the 10-minute was not sufficient for the strength of this possible upward move, right? You know what I mean? So the if I go down, to the 5 minute, it's gonna be the same case, because you already spot where it was wrong, but you spot where it was right on the 15-minute. So can you constitute a trade on the 10-minute? Yes, but will it be better if you wait for a 15-minute one? Of course, I understand, Remy. You don't want to wait for an hourly, but even if you wait an hourly candle better than a 15-minute candle, it's gonna give you a lot more even confidence for that trade. So, or let's go down to the daily. You know, it broke this support right here. It went and it held it with a very green candle above it. There's no confirmation because it's still not above this candle high right here. But you can start looking at, okay, this low got defended. It became a bear trap. So now let me look for longs. The edge is to the upside. The next day, I think we traded this. The next day, Tesla opens about the prior day high, and it's a straight up long. It's a straight up long. Let's go down to what the next day did. Oops. Yeah, 30 days. Sorry, guys. So yeah, you end up opening about the prior day high, which is this one, and you look for a long. Does it make sense? The bear traps, this is market structure, right? We have bear traps, we have confirmations. So the higher the time frame you go, the better the confirmation you're gonna have. I usually tend to look at stuff on the 5 minutes, you know, to consider a trade or an entry and all that. But I either call it off or let's say, you know how sometimes I say trading ballot or trade, or we're on the rider's seat, you know, or the driver's seat of the trade, is once I get like a higher time frame confirmation that the trade is working against me or with me, if it makes sense. Do we all get that?
I I think I understand. I just need to practice. It's really hard. It's hard to really use it in practice. Easy for me to say I get it. That's the only issue.
Yeah, no, all the concepts that you get right here, it's you're gonna have to apply it on your trading, right? So even if I call out alerts and all that, it's good for you guys to understand what I'm looking at, and if it doesn't work, if it makes sense to hold or not. Case in point, let's say like Amazon, right? Like there's a moment where the short does make sense, you know. Let's look at this. Let's look at this right here. I am looking at Amazon to because it broke this low right here. I looked at it on the on a smaller time frame to go short because I think it's gonna drop all the way to the 618. So to me, dropping this level, which you ended up looking at this peak right here, right? It becomes a support, or yeah, it becomes a support that fails to hold. Then I'll be looking for Amazon to drop into the 618 to then possibly flip long. But that's a good, I think this is a good trade idea. Now, if you go down to the 5 minute, let's say, the trade when we got in was at a very good place because Amazon went from here to here. And this is when the fib retracement I'm going to talk about, we ended up joining the trade right here. So it was a very good entry. And we got the drop that I wanted. But when do you call this trade off? That you're not getting continuation. First of all, when this drop, this candle quickly recover. If you remember correctly, this candle didn't like drop, stay there, and then jump. No, it was like drop and then pump. That's a sign of getting out of the short, possibly joining a long. Okay, rid of this alert. But how do you call this trade-off? If I'm shorting this level, that was a 50% retracement from this drop. I know I'm wrong once it trades above this right here. And I'll go over the favorite retracements and all that in a little bit. But I'm already wrong, and on a 5 minute time frame right here. If I go up, I'm sorry, to the 15 minute, I can for sure know that I'm wrong right here on this close. And it's by looking at the time. You look at the time and you'll know how much of the time left on the candle is, and you'll know that you're wrong right here. You know that you're wrong, you know. The candle closed not only above this level, because you're only looking to close above this level. The candle closed above this high. That's a straight up, you know, it's time to cut the trade. You know, it's gonna be a big loss because it was 0 DTEs, and it is what it is. But I think, if I remember, Remy, you ended up, cutting the trade all the way over here, right? So this is when, understanding when you can be right and when you can be wrong is key, right? Is key. And I know this trade was not ideal, guys. It was not ideal because, yes, I did get to sell something right here. Not all the way over here. It was 50%. Right here, I start selling. You know, when I peak a new low, I start selling, you know, it was like 35, 40%, something right here. I did not get to sell 50%. It was too fast. You know, I understand that is way too fast. We don't expect the trade to actually reverse that hard. you know, especially because my target, you know, becomes this, right? It's all the way over here, you know. So this is where I'm most of the trades I was planning to get out. It just didn't happen, guys. And I will talk about position managing a position and how you should be managing a position that happened. And we're gonna use Amazon as an example. So going back to market structure, you know, that's the type of market structure that I want. You know, candle. If you want to put like a sub point right there, candle closes and different on different time frames. You know, breaking levels and being above levels on different time frames. Okay. All right. Uh, we're gonna move on from that unless there's questions about time frames and candles and how strong are on all that. Next up is gonna be on market structure. We're gonna be looking at something that I repeat myself a lot, which is basically that I'm sorry if I'm blinding you if you're in a dark room. But we're gonna look at this on the just give me this right here. Okay, the market does not go up on a straight line, neither goes down on a straight line. Market structure calls for a set of, if you're gonna have a trend higher, of higher highs and higher lows. You know, sorry, it looks shitty, right? But you basically place your first high and your first low, and then you're gonna have a higher high, and then you're gonna have your first, sorry, higher low, and then you're gonna be looking for another higher high, and then you're gonna be looking for another higher low. Thus, the trend having continuation. That is part of the market structure that I want you guys to understand, especially if you're trading options, right? Because this is a good example for Jerry. You know that whenever you're like, let's say you're swinging chop calls and you get like a 2-day, 3-day impulse move, um, you should look, you know, to book profits and stuff like that, and something, you know, you're potentially not gonna get the last point, but you can get something like at least right here, something like this before it pulls back, because the profits of this are at this point after this pullback are gonna be the same ones on options all the way over here. You know, it's not gonna be the same, right? So you do have to look for places where, you know, that you cannot just hold something like straight up like that. You know, you have to take your targets, all the stuff, right? On the same manner, what we just seen right here, we're gonna look at the structure of the market to the downside, which is a set of oops, that's an ugly ass chart. But you're gonna have your first high and your first low, and then you're gonna be looking at a lower low and a lower high and a lower low and a lower high for your structure. This is the only two ways the market can move. You may say, but Cube, it also goes sideways. Well, sideways is more of a term where it tries to make it has a battle between making a higher high and then doing like equal lows and trying to make a trend, you know, to go lower and then making a higher high. So it's like you can say like it's going up right here, and it's going down right here, and it's going up right here, and it's going down right here, thus making what you want to call a guys say sideways situation, right? But you still gotta understand that the market is still goes up in two manners, right? Which is a sorry, gotta finish it. You still gotta look at this on a manner that the market moves in two directions, which is going up and going down, right? I know it sounds very idiotic and simplistic. I understand that, but if you understand this, you'll understand why patterns form. And we're gonna be looking at the bull flags and bear flags and the head and shoulders and all that, right? You know. So let's go into what one example of a let's say a bull flag, I guess, which is we're gonna start with a bull flag. So it means that you're gonna have this possible run up, right? You're gonna have your first pullback, and then you're gonna go higher like this. And I'm gonna combine this with the favorite tracement section, okay? The favorite tracement section calls that whenever you have a favorite tracement, you have a starting point, you have an end point, and when you draw your fibs, you're gonna have a fib level right here, a fib level right here, and a fib level right here, right? Which is we basically use the 38.2, the 50%, and the 618. Oops, this is the point is goes here. Sorry, the 618 right here. Okay, so the bull flags are basically when you have an impulse higher, you have a pullback, and this what constitutes the bull flag, this pullback right here. Anything that pulls back into this favorite tracement, or this favorite tracement, or this favorite tracement, is still a bull flag. Now, you can judge the strength and the possible push higher by the amount of retracement that you got on that bull flag right here. So you're looking at that you make your high and your low, and you're gonna make for a higher high, and then a possible higher low in the future, based on market structure that it goes like this, right? So when you have a favorite tracement right here, the bull flag forms in between touchings and bouncing off of these points, and you're gonna know the break happening of the bull flag once it breaks this high right here. Once it breaks this high right here. But you will, I like to think that buying the market, buying the stock or whatever on a possible pullback of this, it gives a better edge than buying right here, because this break right here could potentially fail, right? And so we don't want to be buyers of the new high, right? Of the or the bull flag break. We want to be part of the bull flag once you spot it, right? It's just better. It keeps better risk reward. So you're gonna judge the strength of the possible breakout on the higher time frames, the deeper the shallow that you pull back into the bull flag, So a bull flag, you'll determine. I don't like to use shapes and forms, guys, but you'll determine the strength based on where it pulled back into. The higher it is, the more strong you can go.
Okay, quick question.
Yeah.
So you drew the bull flag, right? So this is what I don't understand. Like, you're drawing the fib retracements, right? The 38, the 50, and the 618, right?
Yeah.
If breaking a higher level, why is the fibs reversed? Is it?
Oh, well, now I'll explain that in a little bit, and that's because this is the bull move, and you're also gonna have the bear moves like this, right? So, you can imagine that this is you can see what this is, an uptrend and a downtrend, right? If you can answer, that'll be good.
I thought it was a rhetorical question.
No, no, no.
I'm here.
No. I want you to answer you so you understand that. Now, what if you can actually zoom? If you can actually let's say that, imagine this move could be this part of the move could be this part right here. It almost looks like I drew and copy paste the picture, right? No, but this move could be this. So in this move, you have a you have a fib retracement, right? Which is, let's say that the 50, the 61A, and the 38.2, right? It went to the 50 and rejected this move. So why would you put fib retracements off of this move? Because this could be the potential outcome of this. It means that it's making a trend reversal. So instead of breaking this bull flag, now you're looking at a trend reversal to the downside. Does it make sense? That is not a rhetorical question. I want to ask if it makes sense. This. If not, I can explain it, I guess, a little further, but that should be it, right? Because the sellers at this leg think about it. Buyers on this that saw this move right here have a chance to buy this at a discount on a pullback to push it higher. The sellers that see this move have a chance to join a discount when it's higher at this points, your favorite retracements, to then take it lower, right? So that's why we look at how we know that we're on the driver's seat. If you look at this favorite retracements right here, you're above the 618, it can still go around. It can still make an equal high and drop, right? But how do you know if you bought this level and you're in profits up to here, you still gotta be where your tippity toes, that this could reverse back down. Once you're here, you increase your chances that this is gonna go higher, and then you start feeling like you're gonna be you're on the driver's side of the trade. You're cruising, and once you break this high, you're cruising as well, right? We do use the extension of the 10% for possible targets because a lot of the moves tend to finish with just a little poke of the high, and that's it. But you're still at good profits if you take something from here all the way over here. It's something that you gotta take in, and if you end up having a even going higher than this, let's say you're carry some contracts over here, you're now even more on the driver's side, right? Even more cruising around. You still gotta watch your position, but you can expect, once you're above this, you can expect to even go higher than that, and potentially do a double the size move, so you extrapolate this move that happened right here, and you kind of place it from a starting point right here again, and you can have it the same length that you have right here, the same length that you have right here, from the starting point that it made that go. But you have to know that that there's potentials for turnaround. Even though you had a good place and the trade is working with you, you have potentials to go against you at any of the favorite retracements at the equal high, at the 10% extension, So those are all possible targets for your trade, It doesn't mean that you're gonna just scalp and take the trade off right here. You can carry the trade forward with your full position better, right? But that's gonna be based on your risk assessment, on the how good the contracts have moved, do you have room? What else is coming up as our support? Are you hitting an EMA at the highs? Something like that, right? So, but this is a good, at least, you can pull off a trade like this. Does it make sense, Remy? Does it make sense right here that you can have this possible, turn around to the downside, after you make this leg higher?
I got all the way to the point you drew that line in the middle.
This one? Okay. Yeah.
So what are you trying to do right there? I don't understand.
Well, what you see on bull flags sometimes is that once you're past all these bear retracements where sellers could join in, Once you pass the equal high, once you pass the 10% extension, you kind of shoot for an equal leg up, you know. I'll show you an example right here on Amazon right here. Let's say that you, after this breakout, you already know that the edge is to the upside, not to the downside. The bears got trapped right here, like we did, I guess. I'm glad we didn't short this area, you know, because people were short like, oh, it broke this low, let me short. You know, people will short that. You know, we're short from here, and we can take the trade off once it goes back to break even. You know, stuff like that. But the idea is that now the move is to the upside. I'm gonna delete this favorite retracement. I'm gonna show you what the bullseye is, right? Because we're looking at a bullseye on the whenever we're doing those drawings, right? So we're gonna draw from here, starting point to the end point. How do you know that this is the end point? Only after this candle. Only after this candle you know that's the end point, right? So because this thing is gonna just, when you trade live, it's gonna be going up. Then you see the candle close, and you're not even gonna draw a fair retracement until you have a good pullback candle, right? So you're gonna have this, and knowing that you can buy things on the 50, on the 32, on the 50, or the 618. You know, if you end up winning, let's say on the setup for a 618, you're not gonna get it. You join the 50%, you can actually have your stop loss in below the 618 and stay on the trade. Now, what can you expect a lot of the times whenever you're good like this? You're gonna draw the other side. You know, why do we draw the other side? Right? Because if you notice, there's gonna be, and there was an attempt, you know, there's gonna be sellers sitting at the 618, at the 50, or the 32. You're gonna be seeing sellers, look, just as it's seen right here, trying to short the 618 at least, you know. Where are the sellers runs? When it trades over here, right? And you're on the bullseye. You bought right here, so you're looking for this to feel comfortable on the long position once it does this, right? Can you take profits from here to here? Yes. But you want more, you see the possible move higher, you're gonna just stay on the trade still, right? So we're gonna go back to our bull perspective, which is this. Right here. Right? Where the bull perspective is. And once we go to a 10% extension, if you see like a stalling, like a quick boom, it stopped right here. Like it didn't go higher. Like it just stopped. Then you'll be looking at to take profits right here on most of the position, you know, because 75% of new highs, because this is a new high, tend to fail to have continuation. Just like this new high that it broke. This was the day's highs at this moment. This new high actually failed to have continuation. Doesn't mean that it's gonna just dump, but it just means that that could be the start of the pullback, right? That's why, let's say you're never gonna buy breakouts. Let's say, oh, I'm gonna buy Amazon only if it makes a new high of the day from the opening range. Bad idea, brother. Bad idea. Yes, it can work, but bad idea, you know, because 75%, and this is a somewhat made up statistic. It's just I don't have the exact sources of the statistics, you know, the numbers, sample size, or anything like that. I read it somewhere, you know, so I'm passing it on to you what I have in my head, right? Which is 75% of the highs failed breakouts. So what you're gonna have right here is basically you're gonna look for, instead of buying this, you're not gonna short it either, because you know that the edge is to the upside. There was some money to be made on the short, but obviously you're gonna get more moves to the upside, right? So you end up joining the 50%. You know that this is the 618 on the bear side. You trade above it. You're more of a driver's seat. You look for an equal high. It breaks like butter. Doesn't stop at the 10%. It breaks like butter, and you move your expectations to make. Let me measure you to you right here. We're gonna make a move up right here from here, so you understand this. Oops. We're gonna do a purple just so we can see it. All right. All right. So we have this move right here. This is the same length from here to here, right? Of what just happened. So you're gonna place it from. You can place it from the 50% retracement, and this is why I have this right here, the 50% extension, because it means that this move at a 50% is equal to move right here. It means that half of this move right here, from this point of this, the ending point right here, is half of this move right here, and that could be your next target right here, right? Combine it with other support resistances and whatnot, right? Like this highs right here, right? We have established from later, and basically that's what you would expect. Like, can you put it where the move actually set the lows right here? Yes. And case in point, I mean, you're close to it, right? Not exactly there, but you kind of close in it on this highs right here. And if you look further into the session, we actually ended up going higher, right? But you get the idea of this setup, right? You get the idea of why do we take this right here. And this is basically a bull flag, which it may not seem like one, but this is a bull flag right here. Oops. Oh, fuck. That's not what I meant. Now, does it look like your ideal bull flag? Does it look like your...
Quick question.
Yeah.
Quick question. Why do you draw the same length? Is it because it's the same length of time that you're trying to?
No. It's the same length of the price move, you know, of the price of what just happened on the price action. So you actually have different levels, you know. You can actually go for the let me see. You're gonna add this 70.32. We're gonna add the negative 0.6. I'm sorry, 618. We're gonna add this right here. Okay. Look at this. There's more levels to actually take profits right here on this trade. I tend to have the 50%, but I'm very aware of this ones as well. And if you go for a actually let's add another curve, which is gonna be it's gonna be the -1. I just put a -1 not because of the yeah. In fact, you can add even another one. Let me add another one. 0.78 right here. So you can have all these levels, you know. The fifths have a ton of levels in between. The 0.23, the 38.2, the 50, the 618, the 78, and the 100%. Those are all viable for you to have, right? You can have that as well right here. When you pull a fifth level on TradingView or anything like that, you can have all those levels right here, like the in-between right here, in-between. I think it's a lot of clutter. I think it's, you know, I'm very aware that if it doesn't make it to the 50 and it pulls back before, it may have done it at the 32, you know, or the 618, you know, if it doesn't make it to the, you know. So I like the how often I see the market going up to these levels right here, you know, which is the 10% and the 50% extension. Does it make sense, Remy? It's just I see it a lot happening, and that's what the levels I like to keep. But
Okay.
and we have the equal move because I mean this is basically a lot of the times you can extrapolate this move, right? This move right here. Let's say from equal highs, that will take you all the way right here. They did not reach there, right? It did not reach there, but it's a potential target, you know, for the upside. If you go down to the 15-minute, you'll see a better representation of this bull flag right here, right? It looks better on like what you see on the pictures, because the market, I know it doesn't look like the pictures of the internet, what a bull flag looks like and all that. But this is basically it. These three candles right here on the 15-minute are a bull flag. This is a bull flag break. This is a continuation of the bull flag break, and you only get to see it was a bull flag right here after the fact. But you're gonna start betting that this is a potential bull flag. And that's why you call everything a potential bull flag, a potential setup, that has already happened. Good for moving on. So that's part of the fee retracements on the bull flag matter, and I want to add to the shapes and forms that when you the same's gonna go for the bear flag, right? You're gonna have a leg lower, a pullback. This is the bear flag, and then the breakdown, which is the market moving on a downward direction. And you can see as an example here on the 5-minute. Leg down, pullback, bear flag, breakdown, targets. Did not have continuation, no, but we actually got the 10% extension. We were good right there, right? Let's see. How do we, just so you understand, I'm gonna give you an example so I can move forward. I think I thought I would have covered a lot more by this time. Cannot believe it's been this long. So when you're gonna have let's say an uptrend, and then you're gonna have a downtrend. Let me combine this for you. Oops, that's not what I wanted. I want the select. Okay. Let me combine this. How do you make a head and shoulders? It's basically, oh shit. Let me do the select box a little. Magic. Das. Head and shoulders, baby. I love this because that's how markets reverse a lot of the times. You have an uptrend that switches to a downtrend. That's the whole premise. Don't think that the market is dropping because it has a head and shoulders and everybody sees it. I don't think that's the way to think of the markets. It's just think of it like this happens not because people are seeing it and they want it to happen. This happens because there's a change of direction. Right? Very cool, huh? So when you see something like a descending triangle, right? You have a stock that went let's do different colors. That went down, that went up, that went down. You all see this pattern, right? You all see this pattern happening a lot in the market. I'm such slow. I should have hotkeys for this. So anyway, you get the idea. So you see this pattern right here, and people will actually go for, oh, everybody sees this pattern. They're waiting for a breakout. So you're looking for something like this. Then you're probably looking for something like this. And then you're looking for something like this. It's very, very classic setup. But when you understand why this happened, right? So we're just gonna, I don't know if you want to take a picture or what, but it looks so shitty. Let's actually just expand the drawing right here. Let's go lower. So basically what you have right here, it's a downtrend that is starting to make a lower high right here, but it's meeting with buyers at equal price. It's trying to make a lower high. You know, it's still trying to stay on a downtrend, but it's getting buyers at equal price. So, thus creating this shape right here. The downtrend is happening. You're having a set of equal lower highs. I'm sorry, but equal lows. Now, the buyers are wrong at some point if the door opens, right? I mean, to the downside right here. And the sellers that are making lower highs are wrong once you start making a new higher high from here. So it means that this high right here becomes a higher high for the first time after having a set of the highs and a lower high, lower high, lower high, lower high. You have your first higher high. What you look for? Your first. You have a low, which is an equal low, doesn't change. Equal low, equal low, equal low, and then you have your first higher low. This is market structure. This is a failure to go lower, and then you have your continuation lower. What does it change on the other side, right? When you have a leg down, that's now, and it makes a little higher move right here, and it moves like this. So what do you have now? It's basically a lower low and a lower high right here, where the market structure has decided to go down at this point. So all these shapes, forms, patterns that you guys see is basically a market structure working, to decide what move is gonna take over. Who are the ones that are gonna take over, the buyers or the sellers? A lot of Jerry harmonics and all the stuff is basically to that extent. Those I don't know the names of the patterns. She knows them, but those bad things patterns, that you have this kind of like triangle right here, and then another triangle right here. Is basically the market making a low, a high, a higher low, and then going for a higher high, right? So those are the patterns, that you see on all that. And it is good to use patterns to identify, their visual aids. They're visual aids of what is happening. But understand, like this, there's still like all those highs, all those lows, all the stuff is still within the market structure of these two types of moves, right? On the same vein, you can have like an inverse head and shoulders where a downtrend becomes an uptrend, and so on, right? So it's very important to recognize those structures of higher highs and higher lows, and lower highs, and all this stuff. If we can move forward, I think we can. We're done with favorite retracements, market structure, trendline supports, and we're just gonna move to simple and exponential moving averages, which is it's gonna be quick, and compression and expansion, which we're gonna combine those two. We're gonna go down to the what stock? Let's say one of
I have a question.
yeah.
How do I find the 1,000,000% gainers? That's why I'm here. 1,000,000% gainers. Thank you.
Well, the 1,000,000% gainers is when you find a setup that can have a lot of range. Whenever you spot a very cheap contract on the chain, that's how you get them. If we can look at the example on Google, on Google, I had a target of 10% extension, which actually that's where the market closed, right? From a daily setup. If you notice, this is a daily candle, and we took some 0DT contracts on this trade, right? So if you go down, let's say, to the 5 minutes, we have this as a daily setup. At the moment I took the trade, Google was trading above this high right here. So that makes me think that the Google can easily reach the 10% extension, if not more, right? Which it became the 109. That became like up to the momentum at that point for my trading style. I think I joined a bad place for this trade, but look at this. This is, you see this yellow line right here, right? I have a good support resistance that I broke. Let's actually put another one right here, which is the temp. I should have lowered that. Okay. Okay, let's go down to a 5 minute. So when we took this trade, Google was trading above this area right here. So this is clear. This is clear out here on the on the on the daily. On the daily, this is clear, right? So at that moment, I know my target is 10% extension, which is 108.31. I did not think that Google was gonna reach the high. You know, that's just when you carry runners and all this stuff. But I did think like if it was gonna make, let's say you're looking at the 108 contracts on the option chain, they're worth 10 cents. Think about it like this: they're worth 10 cents. It means that Google, for you to be break even on the trade, Google will have to trade a 108.10 right here for you to be break even on the trade. If this is your target, you can best bet that the Google contract can get at least this is 0.30. You can at least get 10 cents in the money. It means, I mean, 20 cents in the money, 30 cents in the money. It means that the Google contract, if you reach this level here at the close, it's going to be worth 30 cents. So your contract is going to have a 200% gain by then if you bought it at 10 cents. That's why we took it. Now, it went higher. It gave 1,000%. But that's because there's a lot of things that if you guys got to understand option Greeks, guys. Got to understand option Greeks. I guess I'm not going to have a structure on the class, but I'm just going to go with the option Greeks. So, the if you make it to the point that you could have a 200% gain before the close, you're gonna have a lot of extrinsic value still in the contract. Volatility is gonna increase, and why volatility increases? People say that volatility increases only on the downside, but no, volatility increases when people jump into the contract at the same time. So it does pushing the price higher. Not only that, but you start traveling into more intrinsic value. It became in the money. It was in the money. Then it had a whole dollar of in the money status right here. That's why it was worth from 10 cents to $1.10 because it reached plus 109, you know. And like I said, most of your position, I mean, my type of trading will be off right here. That's where I'm out. Most of the trade. And anything that goes right here, it becomes runners, right? Because that's my target. What can I say? It's just part of momentum, you know. That's how you get that 1,000% gainers. That's how you get the big gainers like that. You spot a cheap contract and a very possible target on the daily. Just go for it, right? Go for it. Going back to the market structure. Oh, no, I'm sorry, the EMAs and all that. I'll leave you with a couple of things, guys. The daily 20, the 20 moving average is 20 or 21, you know, whatever people use, somewhere in between. Is very important on the daily, on the weekly, on the 5 minutes, 15 minutes, 30 minutes, and I'll show you some examples, you know. The strength of the trend will be determined of how far you're doing those pullbacks into the daily 20. You know, something that is not extended. We took calls for swings right here on Google. Because this is, what do you see right here? A favorite retracement into the 38.2 plus the daily 20. You combine these two things right here, a daily 20 or whatever time frame that you're looking at, plus a favorite retracement on your chart. That's a long signal, guys. That's a long signal. We took calls right here, and then this is a target, right? What happens if Google goes higher? Like we actually close about the 10% extension. The next main contracts that we have, the rest of the position that we have left, guys, where I still have 1/3 left, I'm gonna aim for that 50% retracement. Now I know that there's another peak right here, right? So I'm not just gonna go like, oh, I'm gonna go straight up for 115 right here. There's levels to be taken in between, you know, this one, this one, this one, and then and Steve, things don't go straight to the price, right? Because at some point you have this difference between the price and the EMA from year to year, and it becomes dangerous to be long on this, right? New positions for swings and all that becomes dangerous. Look at the how far we are right here as well from the EMA, right? From this point to this point is far, so you can still join the momentum. I'm not gonna say you're not, right? That's a very clear break of this, and this. This is a break of a new high on the weekly. What if it just, you know, most of the highs tend to fail. What if it just comes down from here? I have a reasoning to think that the Nasdaq is going higher, so I think Google may give us this target at least on the future, you know. But I'm just speaking about a trade that we got going on. But we should focus on the class. But this is a good example. The daily 20 EMA, you know, sometimes you get exact touches. When you're below it, you look for shorts. They say a short right here wouldn't have worked. A long right here would have worked for a little bit, but not that much. But let's say this is the difference between this right here. Look at this. There's a free retracement that you can do right here, right? Right here is the daily 20 aligning with any of our good free retracements that we like to take? No, it's way higher, so it's not a good long opportunity, you know. But let's say you have a very impulse higher like this, and it aligns with the free retracements on the daily 20. That's money. That's money right there, you know. This one, it was not that good to join the trade right here because there was still some extension. I expected Google to drop. It actually took its while, but once it made this candle, it was like, okay, let's get in, you know. So, you know, that's the type of trades that we're gonna be looking at. You know, there's a possible good example right here. Right here, look at this one right here. This is where the uptrend started. Good push higher, right? 618 retracement, very close to a daily 20, but this is like the last point that you want to buy, and you can be a buyer, you know, to at least equal highs. But look at this, 10% extension, right? Obviously, this probably the profits on options from here to here are probably gonna be even less right here because you have to endure this pullback right here. But at this time decay. So it's not a bad idea to be taking profits right here and stuff like that, right? So that's the deal with EMAs. I'm gonna show you an example of how you can keep tabs of how strong a trend is moving based on EMAs, and I'm gonna give you an example on ES. Let's say, for example, that let's look at Thursday session. You had a bounce of the day we had a good trade right here of the 5-minute 20 EMA, right? So once it's lost right here, you still are in an uptrend. The market is still trending higher. This is a little tip right here. You're gonna go down to a 10-minute to spot the next possible bounce. Right? Next possible bounce is right here. Didn't work. I actually don't like to use a 10-minute at all. I don't even know why I have it. Let's go from 5 to 15 to 30 minutes. From 5 minutes, it went to the 15-minute EMA. Right? Like, it makes total sense. And it does another bounce right here. Now, it doesn't do it right here. Where can you expect the next buy to be? Let's go up to the 30-minute. You can expect the 30-minute 20 EMA to be a next buy area for a trade higher. Yes, I know it's not going super high, but you see the bounce. You see from the 5 minutes to the 15 minutes to the 30 minutes. Let's go down to the hourly. Look at this lows right here later on the session. 1 hour EMA, 1 hour EMA right here, 1 hour EMA right here. This is the non-farm payrolls. Let's go down from the 1 hour to the 4 hours. Boom. Non-farm payrolls, and actually this EMA, when the EMA was right here, because they're dynamic, it was to the penny right here. Once the trade, since it's a moving average, it takes an average of the candles. When it trades very very high up, the EMA is gonna move up, right? And the 4 hour EMA was met right here, and it got some buy demand. Not only that, but I think it was a level on the hourly. So you have, let's go down, right here. Yeah, it's a level right here on the hourly. So plus the 4 hour EMA, 20 EMA. So you can see that the trend is still respected, but it's going from a smaller time frame to a larger time frame. So it is losing strength, but it is, the perspective of the trend is still there, if it makes sense. Does it make sense, Remy? And it is workable on all time frames.
Why you always gotta ask me if it makes sense?
Because
Keep
you're the
saying
only,
that Jerry gets
bro.
it.
You're the only participant, the only person that's participating right now. So I wanted to ask.
I'm the only dumb one. I see how it is. I see how it is. And no, I don't get it. Okay, I am.
I didn't mean it like that, man. I didn't mean it like that. But you can see,
I
like,
know.
and this stuff is very good. There's some trades to be done whenever you see like a possible setup. Let's say for the hourly, there was a hole of the 1 hour to 20 EMA. There's a hole. There's a hole right here. There's a hole right here. There's a hole right here. Oops. You know, no hourly closes below it, all above it until there's not, right? But yeah, until there's not, and the next one becomes the hourly. So it's good to go from the 5 to the 15 to the 30 to the hour to the 4 hour for this type of moves, right? So now that we see this bounce right here, if we do end up having a pullback into the 4 hour, is viable, or the 4 hour 20 EMA is viable. I also keep the 50 EMA, but I don't really use it that often on smaller time frames. This is only something that I use on, actually mostly on individual stocks for setups, for possible highs when you're on a downtrend and stuff like that. Uh, but that's the premise of it. There's some stuff, there's some EMAs, let's say like the 200 SMA. Some people use the 200 SMA, and I think it's in one of my charts right here. Okay, this is a 200 SMA. Some people use it, I guess. I started using it because there were some peaks that we have right here, right here. So I was looking, some peaks that we have right here, some lows that we're setting right here. So this is a concept that I have, that the EMAs, you can use any type of EMA. It can be the 21, the 25, the 30, the 35, whatever you want. But the thing is that if you see multiple interactions with it, use it. I keep the 20 moving average because I see it all the time. I see it all the time. But my takeaway is that you can use any EMA if you see, like, it's like a trend line, right? You see two touches, bet for a third. You see the break, bet for the breakout. So that's the perspective on it. Moving on. Uh, Compression and expansion is about the same idea of the EMAs, guys. Of the EMAs. Let's go to the SMAs and EMAs, but I like to use the EMAs. When something has what's a good example? Because the market has been sideways lately. What breakouts have we had lately that that was
Breakouts?
meaningful? Yeah.
Uh, Nvidia.
Mm, no, I guess yes. I guess something that was. Have we had any daily inside candles lately that we played?
Cope. Copa had tripled inside candle, but
Oh,
that's not really breaking.
no, we
It's
haven't,
not
but
breaking.
we haven't. It hasn't done it. Something else done it already, so we can look at an example.
Uh, double inside candle breakout. Damn. Was it Oxy had that? Did Oxy have that? I'm not sure.
Nah, I don't think so. Let's look at possible Neo.
Me? Oh my god.
No. What can we do? Look, this could be a good place for a long, by the way. In respect to this lows right here. We may start looking for longs on Neo.
Let's
Okay.
go. All in, Jerry. All in. All in Neo. Now.
About
Don't
what?
worry. Okay, just go all in.
About
Who
Neo what?
cares?
Let Jerry talk. Come on, man. She was gonna say something. Oh, she didn't. Oh, anyway, there's a good setup right here. Only if you believe that this low is getting respected and it's gonna make an equal low. But you're looking at a possible, what do you call this? A possible head and shoulders, right? You got the shoulder, you got the head, and if it does reject at this high, if you're long in Neo, right, and you get some profit, it rejects at this high. What do we talk about? Some shapes and forms, right? Is the uptrend that was here? You guys see the shape of the uptrend is now could be met by a possible downtrend, right? So it is, since this low is getting respected, it is a good area to go long. But what do you have working against you? The EMAs, the daily 20, which you could make a lower high. What do you have on the fib perspective? You take out this high, you can take out this low. These places are points of turnaround. If it turns around right here, it's also this high right here, the 38.2, and it could still go lower, right? Your only driver's seat if it trades like right here. But can you take a long right here? Yes. So stuff like that, right? So you adjust your expectations, to how it is performing. I wanted to see. I can think of an example where you see a compression that is very, very clear, because I see compressions right here, but I wanna show something that had a nice compression. Let me see. Let me see. Nice compression. This may not look like much, but this is an example right here that I thought about it. This is basically when the candles are getting smaller, when you're just trading sideways for a long time, you're gonna have a springboard action, right? It didn't go far, I know. I may have to look for a better setup, right? But I guess you just have to know, if something's staying sideways, it's not gonna stay sideways forever. It's
I
not some.
think ZIM had like.
Oh yeah, Zim, right? Yeah, I think so. Let me see. This one right here, right? Had a good. Oh, that's an ugly sale. What happened right here? Yeah, yeah. So
After the dividend post, they just sold. It just went off the cliff.
no, but
That was the one thing.
it was a big dividend, I think, right? That's why.
Yeah,
Yeah.
it was like it was.
Oh, that was
$6.
so clear. Look at that. $6.40, $2.95. What are they thinking? They're giving everything away. But look at the setup. It was a same sale right here, same sale. How come we didn't short this?
I think I posted it, but you guys, I don't think I got lost. But look at it. If you look at it, right, I think that honestly, I think it's a stock manipulation thing, but I'm not gonna say it because you post a big dividend, right? The demand of the stock goes up. right? So then now all the insider traders or the people that want to trade the stock, have
The
their
sheep.
stock.
We call them
They
the sheep.
sell,
Okay,
yeah, they
let
sell it, right? They sell it, and then afterwards they buy it back up at a cheaper rate.
let's see. I don't know. Maybe we can be ready for the next dividend day on this thing. So this day is March 4th. No, I'm sorry, April 4th. April 4th right here, and this is April 6th. Okay, let's go down to the 19th put of April 21st to see what could the price be on April 4th. Right here. You could have got this at the close of April 4th right here at $1.17. Then the dividend drops and $1.79. So there was some money to be made, yeah, on the short side. Remember that sometimes those contracts adjust, they know that, it's an event that is kind of predictable. Not because Zim actually because you know that the dividend is coming, you know how much of the dividend it is, so you can get on a calculator and discount 23.50 minus 6.40 gives you, what is that? I'm sorry, my math is off. 23.50 minus, what would you say, 6.40? Oops. 1710, so it looks like it kind of dropped towards the 1750. So they adjusted around, this is the adjusted after the dividend from this price forward, right? So this is basically like new price, so the market kind of knew already what it was looking for, to go after the dividend day, if it was gonna keep the same level of interest from this point right here. I do have to use a calculator, Remy, for that kind of stuff. I'm sorry. I'm not good at math. I'm good at charting. All right. So this was a good example for compression. And this is a good example for trading sideways and bottoming as a bottoming pattern, right? Because stuff gets to have extensions from the, let's say, from the daily 20. And a good short will be until you meet it, or a good long will be until you're above it, right? But if you can either fill an extension by going, let's say for example right here, back into it and then go up again, or you can fill it by trading sideways into it. I understand that. I understand that very well. You can trade into it, or you can trade sideways into it. And so there's still viable trades to do about that. And when something is just getting compressed, it may explode higher, And there was some news or something, besides changing from an uptrend, doing like this kind of cup, deal with this kind of handle deal, There was some trades that we made right here, I believe. We actually traded this inside candle, right? I think we got this candle right here, breakout, and then it continued higher. And we got this. We got this trend line, daily 20 EMA bounce, 2 up to downside reversal, and it went higher. So that was good. So just understand compression and expansion. That's a very basic concept, but I'm having a hard time to explain it. Okay. Moving on. I'm going to try to go over this real quick to cover it under 20 minutes. Can't believe it's been already 2 hours. I guess remember I said that I was going to spend 1 hour to teach you all this? TA? I guess you doubled it in size. It was 2 hours. For TA, now we're going to go on managing a position, and we'll go over it a little quick, So this is the perfect entry and not the not so perfect entry. We're going to go to the what can we use it as an example? The Amazon trade. The Amazon trade that we did on Friday. And in fact, am I only seeing this? Wow, my homework was... Oh, no, actually, yeah, I saw this. This is something that I was looking for as well. So Amazon may trade higher from here. Look at this daily bounce on the daily 20. I remember, yeah. I remember that I was looking to sell around the daily 20, which it was set at that moment. It went a little higher because of this price action, the average move up, but it was like a 99.5. I was looking to target 99.5 on the Amazon right here. It did not get it by 30 cents. It actually bounced higher. So that is bullish, guys. That is bullish, but let's look at the example of the perfect entry and the not so perfect entry. So going by the favorite retracements, you know, a perfect entry obviously is very, as the name says, something when you buy right at the lows, right? Super hard to get, but you can, sometimes you'll get it. It just happens, you know, sometimes you'll get it, you know, sometimes these lows will be at the 618 and you buy exactly a 618, it becomes a perfect entry. You align it with some 20 EMA and it becomes a perfect entry, you know. So the not so perfect entry is still viable on your trading, but you have to withstand some kind of pain, which is basically either buying the 50 knowing that it could drop to the 618 or buying the 32 thinking that this is going to be very strong. And having to sustain this red, having to sustain red, and you're gonna be wrong all the way over here. You know, is the not so perfect entry, but it's still viable. It is, to me, this is a bigger risk. You know, so I don't like to be on the not so perfect entry. The perfect, well, this is the bad entry to say at least. But then I don't have problems with being the not so perfect entry if I can withstand some pain. But I can be, I like to be on the perfect entry, but I know I may not get it. But this is still viable, guys. This is still viable. You just have to understand the risk. You have to understand the risk that if it doesn't work out, you know what a weekly option is going to be at from here to here. Down 20, down 30, 40, 50%. Especially if it's 0DT, it's going to be down 40, 50% from year to year. Quite a bit. You know? That's just understanding the risk of what you're risking right here. And stats, he trades futures, you know? You know, you'll be looking at some setups, you know? Let's say from this leg higher right here. We talk about candle closes. This didn't close below that level, but I mean, you could have stopped out for whatever reason. You buy the 618. We know it looks scary with these red candles, but you're buying the 618 and no candle closes below it. You're gonna be wrong until it happens, whatever. And you if you have bought the 50, you know, you're gonna be risking quite some points from 414 to 412, you know, 412 and a half, 412.25. That's gonna be 2 points, 2.5 points to or risk, you know, that you're gonna have right there for a possible 10-point profit. So it's not so bad to have joined right here, but you still wanna go for a lower risk entry. But they understand, like on the Amazon example, you may not get that entry. You may not get that entry, so you just have to go with it, right? That's a possible scenario if that's gonna happen. Now moving on. Adding and reducing size. So adding, I think, to a trade, it is a very advanced topic, or not an advanced topic, I'm sorry. It's a very basic topic, but it's a very advanced trading technique. Not because of its complexity of executing, it's more of a psychological thing. What makes us confident that this trade may work? Right here. If you bought right here and you get this point right here. If you look at the bear side of this move, right? There was a small rejection right here. This candle does trade above it and closes above it. This is a point where you're in the driver's seat and your expectations are to meet this high right here, if not actually break it and go higher. This right here tells you that if you're long right here, let's say you miss the trade of longing right here, and let's say that you miss a strong going long right here. This is a possible entry if you join for a better setup, for another setup where it just clears the 620 on the bear side and it could go higher. Now, if you're already long right here, you can actually pull, like, you can call it like another trade, which is still gonna be the same one because you're gonna be buying the same product, but you're gonna be adding into the trade right here because now your potential profit is all the way over here. If not the 10% extension, if not the 50% extension. So you go to the 10% extension, it clears it like butter. You take it to the 50%. It went higher, but I would have been satisfied, mega satisfied if I had taken a position from here to here and adding right here, right? So that's a very hard thing psychologically because nobody wants to. You want to be like, let's say Remy is excited for those 1000% gainers. I'll give you an example. If you're very strong psychologically and you have a good trading aspect and whatnot, this is your first level to take profits, right? This level that I had in to take profits, it cut like butter, like hot knife on butter right here. Didn't have a little wick rejection. It was like straight up cut. So instead of taking profits, this is when you buy back, when you buy more, right? This is when you buy more because your target is still 31 right here. So from this point, you can take more contracts from here to here. Is it more dangerous? Yes. It requires a stronger attitude, a stronger mentality to add into average up on a trade because you're gonna make more money with more contracts in, even though they're a higher price, but the profit, instead of looking at a 200% gainer or whatever percent gainer was right here, you may be looking at a 50 or 60%. So it may look less on paper, but it's still more money in the end. It is just hard psychologically. Now, scaling out of a trade, I call it a lot responsible trading. So it requires to be very strict on your price levels that you have in. There's a little bit of magic number, if you want to call it, like, which is 8 contracts. Anything below that to have runners, it's just a little hard, right? Because if you let's say with 8 contracts, you got something that you join right on that move. I don't remember exactly the percentage points that we had right here on each level, but on when you reach at least a good rule of thumb is when you reach 100% gain, if you want to risk off the trade, if you want to completely eliminate the risk of the trade, you sell half of it. So from 8 contracts, you're gonna sell and you're gonna end up with 4. I don't need a calculator, Remy. I'm just for visual aid. I know what a half of 4 what 8 is. But you're gonna sell that to get risk off, right? You can use 10 contracts as an example. Actually, I like 10 contracts better, but it depends on what you're buying, depends on how much it is, the risk that you have in, the money that you have in. But this is for just visual aid, right? Let's just 10 contracts instead. Divided by 2, we end up with 5. Now, 5 is not, it's an odd number, so you cannot divide it by 2. But the next target that you see, you may sell, let's say, 2 of those contracts. So you're gonna end up with 3 contracts, and then you end up going to the next target. You're gonna end up selling another 2 contracts, right? And what do you have left for runners when you met your ultimate target? You're almost all of it. It's anything that was left after it, after you have sold half of half of half. So I know it was an odd number of the 5s, but it's basically, I just round it down to sell half of half and keep a runner to cap a runner at the end, right? And it just goes by any amount that you have, right? And that's if you start a scale out at 100% profits, right? But you can do the scale out the same fashion if you have like 3 different price targets to scale out at those price targets, because you don't know. This could be reached right here and go down. It could reach right here and go down. It could reach right here and go down. It didn't do it. So you better believe that you want to try a to have something in for the rest of the run, but you don't want to sell everything until the signs are there. What are the signs for a possible, like when something's very parabolic, you already extended from this point forward from the 5 minute 20. There was a bounce right here, so you can expect that it's gonna be met later. This is extended. This is extended. And this is way extended. Now, at any point, this thing is dangerous to keep going long at it. You know, it's just extended, extended, extended. Once you reach a point on the chart, sometimes when you have like this, like larger, there's certain characteristics. The larger 1 minute volume showing up for the sell side, which it did. The larger, if you have like a large volume candle like this, and the candle doesn't really move that much, you know, it just doesn't move that much. And I think there was a sign right here that it was topping. You see this candle that didn't move that much, and it has larger volume that they say this candle that did move more. It is a topping sign, right? So a small candle, and I don't like to use 1 minute, but especially on the 5 minute, right? If it's small, if there's a small candle that does have a larger volume, the signs of topping, you know, it topped right, that it could have topped right there. So that's it. You have to be scaling out of contracts on that matter, you know, as the price target goes. It's a very basic concept. You just have to work on it psychologically, because it is very tempting, I understand, to buy a full position and wait until you have 1,000% or nothing to sell it. Nobody, you know what? I tell you what happens whenever a play like this happen. People that did not join this trade, or even people that joined this trade, the next trade that I post, and it prints a 50% gain, people are not gonna take it. Even though it hits target, people are not gonna take a 50% gain, because they're gonna expect something larger like this, you know. So you just have to be realistic of the market, you know. Just be strong minded against what the human instincts can be towards you on trading. That's what I can say, if it makes sense. And it's coming from an individual that is not very strong minded, everything else but trading. And even then, you know, trading, sometimes I'm human, and I make my own mistakes, you know. Yeah, especially like you know, some parts, you know, I'll be hanging on to hope, you know, even though whenever I post trading valid, sometimes I will still hold for a little longer, because it's still within my risk. It's still within my risk. It's not outside my risk. But you know, there's a moment where it's very good practice to say those words, to speak it into existence. You see that the trade is wrong, and you can start saying to yourself, or type it in, or whatever you want to call it, trade invalid. If Google, from this leg higher, actually started off right here on this red candle, from this leg higher, if Google traded right here, I would say trade invalid. Would I still have hold? Yes, because the contracts were probably at 1 cent or less at that point, if that had happened. So but the trade is invalid, you know. Just so if you're long dated contracts, you know, at a you know, a next week expiration or something, you're not gonna wait for that to keep decaying, keep going against you. You're just gonna call it trading valid. That's a good practice. Calling stuff trading valid. You know, it doesn't mean that you were wrong. It's like it's different from saying, "Oh, I was wrong," to saying trading valid. You know, or like, because you can also say you were wrong, but it's not necessarily that you were wrong, although you were. but it's more of a, how can I explain it? It's just better psychologically, man. Because we don't know, we don't have a crystal ball. What's gonna happen, man? I had no idea this was gonna reach to 109. I saw a potential. I took the trade, and we made it happen. You know. Next up. Well, that's we just go over. We just went over the psychological aspect on managing a trade, which is how strong it is to averaging up and how strong. I went over averaging up, but one of my rules that I use, don't average down, guys, and that was a downfall of Gamble. He took a big loss because of the of averaging down and down and down, thinking that at some point the trade is gonna work on your favor. Think of it this way, you know, you have a contract that is worth $1. It goes down to 50 cents. Goes from here to here. You think the trade's still gonna go up. You're down 50%. You buy that contract. 1 plus 50 divided by 2. Whoops. 75. So, wait, is that right? So my average on the contract, yeah. Sorry, my math is fucking. Sometimes I doubt myself because I don't want to be wrong. Kind of knew this was happening. So now my average on the contract is 75 cents. And you think if you go back to $1, if you go back to $1 right here, you're gonna be looking at a gain. You're gonna be looking at a green because you're looking from averaging down the trade. You're gonna be looking at a 30% gain right here. 30, I think it's 33, but let's put it at 30% gain, and you're gonna be happy that you're gonna be you're gonna be up on the trade right here. In reality, what is happening is that you have, let's say you only buy 1 and 1, right? Your contract at 1, it's at break even. You're not in gains. And the contract at 50 cents is gonna be in profit by 100%. The 0.50 entry. So you're gonna have a 100% gain. So this is a reality, guys. You're not 30% up. Your break even here, you are 100% here. If you do a different average up, down, I'm sorry. Let's give it an example that actually shows the dangers of this thing, which it means you buy a 1. It goes down to 25. You're looking at, I'm sorry, 1 plus 25. Oops. Right here, divided by 2. 0.62. This is your new average, right? Right? This is your new average. If the trade goes up to 75, you're gonna be looking at a 20% gain or so. Right here. If it goes from here to here, that's a 20% gain. What is the reality that is happening? Are you green on the trade, really? It is. You're green on the trade, in fact. You're green on the trade. But your one contract is down 25% right here. And even though it shows you're on a 62 average and you're 0.25, contract is gonna go up. What's it? 200%? Yeah. Yeah, right? 100%. Yeah, 200%. So this is the reality of what's happening. You can call it that you're on a single trade, but in reality, you're on two trades. You're in this trade, which is still down, and you're on this trade that is very well up. Does that make sense? You know, it's just very very good perception of what averaging down is. You're not coming out green on this trade. On the whole overall trade, yes, not on this trade right here. And a lot of sometimes, you know, you're averaging down for the wrong reasons. There could be a good reason. I mean, I'll tell you which one is a good reason. Right here on Amazon, that we've been looking at that chart over and over. Let's say that you actually have, that you think it's gonna go on to higher. Your analysis says that it's actually gonna go higher. So if you're looking at, you end up buying right here. I don't think it's a bad idea to average down right here. I don't think it's a bad idea to average down right here. Anything below that, you're just averaging down because you're hoping that it goes back out and it goes green for you. But to eliminate the hope and all that, averaging down for hope, we just eliminate averaging down altogether. You know, it's just better practice to not averaging down on trades. And you're gonna hear from a lot of traders, you know, averaging down. We don't just average down. You know, we take our initial position and that's it. I think actually I saw Brick, you know, going into some. We don't know if this is gonna break higher, right? I think I saw him averaging down or getting a new position. I don't remember, you know, but I mean, it could be if he's averaging down because I mean he's not getting what he wants and everything. It just could be dangerous, you know. It is still within the risk, but then there'll be people, you know, that it is not within the risk, and they'll think like, okay, let me double down. That's a very dangerous term, double down, because in the first place, your initial position, it's already a one size lot, meaning that is your I'm sorry, I don't know why I drew that square. I'm just thinking your initial position is basically your maximum risk at that point, you know, unless you're buying half of the position and then you buy the next half on the next place that you could buy for an average down, then I get it. But if you're getting for the full position at the beginning, don't even think about averaging down. You're in for the full amount that you intended to at the beginning. That's it. No question about it. And if we do this at $1,000 challenge, that's gonna be the deal. That's gonna be the deal. It's just no averaging down. We end up going where, well, the initial positions will be like $200. That's it. No more than that. How much is it we want the trade to go back up? How much is it? Oh, we can expand. If it ends up working, we're gonna have exponential larger wins. Doesn't matter. It's just good practice. And the next step is just understanding and accepting the risk. That's very important, guys, because a lot of people will start asking, you know, are you still in this? Is this still a good trade? Should we average down? You know, should I cut it? You know, all those questions come from within. It's within yourself. Well, if you're the one asking the questions, I'm not saying that you guys are. You guys are not actually, but some other people are. You're basically.
We know when we fuck, Kubiro.
You're basically haven't accepted the risk. You just haven't. You know what I mean? You haven't accepted the risk of the trade at all. Of the amount that you put in, or the amount of the stop loss, you know, you just haven't accepted. That's all I can say. That's so if you analyze it, you know, if you internally think about it, you know, if you ask yourself honestly, if you be honest to yourself once you're like sitting down right here on the computer and thinking, have I accepted the risk, you know? uh, it'll be easier to avoid averaging down, avoid holding for further losses, and uh, avoid doubting a lot. You know, asking a lot of questions. And it's just not that it bothers me, but I just can sense it very a lot. You know, and man, I wish I could tell you who. um, but yeah. Um,
What? Oh, what? We don't.
it's because there was some members that were just. So my question, like Gamble, actually Gamble. I guess I'm allowed to say the name. I don't think anybody's gonna watch this video anyway. But like Gamble, you know. So understanding the risk is very important. It's super important. Um, and position sizing, guys. It's good to think that you're gonna get rich with one trade, but it just doesn't work that way, guys. Doesn't work that way. Did anybody read the Bricks risk management thing?
I do not. Where is it?
It's in Trading Floor. I honestly don't think he wrote that. If you notice, if you go through it, they mention an example of Facebook when Facebook was still called Facebook and it was FD ticker. You know, he could at least change that to Meta to make it a little more believable. But no,
No,
it's
he's probably like he uses it as
yeah
a guide,
he
like a guide.
well it's because the way he phrased it, like a guide I made on risk management inspired by Stockman and Jason. You know, so that's a ongoing thing right now that Stockman and Jason are using good risk management, but uh, but it's but you can tell it's all. You can tell it's all. But anyway, I don't care. I mean that's just drama. But but it is good. I mean, um, you know, it's good stuff. When you guys want to read it. It's not that long, you know. But it explains very much. You know, you're gonna have a 1% to 5% position sizing rule. You know, stuff like that. You know, so in the challenge, we're not gonna apply this, and I'm sorry, we're not gonna apply this. Yeah, we're gonna deviate from the rule a little bit because with $1,000, if you risk 5% of the port, you know, what is 5%? Is $50. We're gonna start risking only $50 per trade. Is too little. You know, it's like I'm not gonna go anywhere with this challenge. But it is, if for your own trading accounts, do follow that rule. Now, it also means that you know you can place a trade.
It teaches like management, you know, and like appreciating sizing. I guess. I don't
Yeah,
know. I think it's gonna teach us something.
we'll see. We'll see what happens. I think let's say for if you have a $10,000 trading account, which is like the most common amount for people to have, you know, for options trading. Uh, I think like this is a for a risk management perspective rule. So to risk at 5%, some actually people go and risk only 2%. So choose between the 2 and 5%, right? If you're more a risky person, 5% is a good amount, and even then, it's like if you, I mean, just hear it. 5% sounds like so little. Like, how am I gonna grow my account with only risking 5%, right? What kind of money am I gonna get? It's just good practice. It's just good risk management, right? And it does not mean that you essentially getting a trade with only 5% of the amount, because 5% of $10,000 is 500, right? Correct me if I'm wrong. Fucking, I'm bad at math, guys. 500. Um, so let's say that you do get in a position of $10,000 account with 500. That's 5%. That's how much you're gonna risk. Can you buy more than $500 on a trade? Yes. This is your risk. It does not mean it's your buy amount. If you're playing ZLDTs that you know they're gonna go to zero, this is the maximum that you can buy on that ZLDT contract. But if you buy let's say that you're not on GLDTs, you're on a more linear way style place, you know, you can actually buy $1,000 worth of contracts, which is 10% of your account, right? I understand that you're not fine 5%, but you're gonna stop out at 50% loss. You know, your loss at 50% loss is still $500. You know, so you're
Okay,
still risking.
quick question.
Okay, go ahead.
If I'm only risking, hold on, I don't know. Like for me, I'm not comfortable with risking not even 1% of my port.
Well,
So
this is another thing. This is another. Let me tell this thing. The higher
okay,
the the port goes, the more money that you have on your account, the less percentage that you should risk, and that's for capital preservation. That's a very if you read any like they explain it very well in Stock Market Wizards. That book is very good. I recommend it. It's the higher you go, the less risk you're gonna take for capital preservation. But if you're not a person, you know, you have a large account, right? And you're still not gonna risk, 5% becomes risking 5 or 10% of the account becomes a substantially large amount. Let's say $100,000 because you have a very large account. You don't want to risk the $100,000. You have to adjust your risk profile to less percentage of the account as the account grows, if it makes sense. I mean,
I would argue take the gains out and use the risk that you can profitably make over and over again.
this is what I do, and I'll tell you what I do. My account tries to stay between well, I'm not gonna give you an exact numbers, but what I have a set amount that I trade with, and if it exceeds a certain amount, that amount goes out to my checking account, and I go back to the same amount that I started with. It's not a I don't try to grow my account indefinitely. I don't try to grow my account on trading indefinitely. I try to grow my checking account larger or indefinitely. So it's at some point you look at what you're comfortable with whenever you're like looking at the P&L. Whenever you start sweating because the loss is very large on as a number, but not as a percentage. But the number is just making you feel uneasy. You want to get the trade off. You want to take a trade off. You should. This is a good practice to keep in your trading account at the same level. Anytime you exceed a certain amount, just take those gains out and keep trading at the same amount.
Exactly, yeah. Because if you're comfortable and you're profitable, leave it like that. And if you want to increase how much risk you take on, do that slowly, with very low increments.
Especially on futures, that you trade future stats. The if you have like $1,000 risk, you can definitely trade with an account that has $1,100 on the account only. You don't need the account doesn't need to be 10K, 20K, or 50K if you always have $1,000 risk. So you just leave $100 for a little bit of room, and you have $1,000 of risk all the time. If you're trading, unless it's a prop trading account, and all that, which is, what I mean. So, you just if you always have that risk, if you wanna have the larger account so you can risk more, you're very welcome to grow that account and risk more money. Can you explain to Remy what you were gonna say? I'm sorry for interrupting you right there.
no, it's just like for me, I feel like I'm risking too little, but I'm risking with what I'm comfortable with. I'm risking like I'm gonna say 0.05, 0.01 of the port because I'm just not comfortable with doing like the crazy amounts. I like if there was like a A plus setup and you guys think I'm gonna get 900%, maybe.
But it's good to keep within your risk because it's gonna avoid you from being trigger happy. It's so maybe we're talking about a very large account and that's why you're comfortable with that risk. It's fine. I will say that, you know, going for that percentage on a $10,000 account, which is a very common number, is very little, you know, to go dropping down to the much. But I want you to understand that, you know, even risking the percentage that you're comfortable with, you know, that which is, let's say for a $10,000 account, you want to risk 500, you can still buy more than 500 worth of contracts if you're outside the 0DTE spectrum, right? That you have, that you know that the contracts are not gonna go down that much, you know. So you can actually go up and buy, like I said on example, $1,000 worth of contracts, but stopping out a 50% loss, where your risk is still the same. Or you can go and buy $2,000 worth of contracts. If you think you're having a perfect entry and you should cut if it doesn't work out immediately, you can essentially have the same risk if you only lose 500, which is what is that, 25%? You know? Yeah, right. So it's 500 times 4, yeah. So sorry, my brain just goes somewhere else. So you can buy $2,000 worth of contracts on a $10,000 account, but you'll need to stop at 25% stop loss. If you end up running into a trade that you feel, I'll give you an example. I feel like I had a good entry on the Google swing, right? This is when I can allow good risk on this trade. You know, a larger risk on this trade because I feel like I have a good trade on a very good entry on this trade right here. You know what I mean? On this swing, not the 0DT trade. The 0DT trade, it was a smaller size because of the nature of the 0DT's contracts that tend to go to zero if it doesn't work, right? But do you guys understand this thing about position sizing?
Yes.
Okay, this is very important because people get this misconception again about only risking buying that amount and sticking like that, because you don't get to grow that way. You don't get to grow that way thinking that you can only buy $500 worth of contract with $10,000. It is true on the ODTs. It is true. Actually, it is true not even on ODTs. It's true on any type of contract. If you're the type of person that does not cut a trade, if you cannot cut a trade for shit, and you'd write the I'm sorry for using bad language, but if you write the trade to zero all the time, only buy the maximum risk, because you're not getting that maximum risk on a non-working trade. Okay. You got this, book cloud? You've been a little quiet today, my friend. Now we're gonna go deviate from this rules on the $1,000 challenge account. We basically, maximum risk is gonna be 20% of the account until it can grow exponentially larger, because it's just it's a small amount, you know. It's a small amount. Contrary to popular belief, it is it's not easy, you know, to trade with smaller. It's hard to trade with smaller amounts. Hey, can I ask you guys, how do you, well, besides Remy, because we already answered, but how do you guys been managing that risk? If we can have a little testimonials.
I sometimes go like full forward on something, but I just exit earlier.
Okay, but it makes you comfortable. It makes you exit early on the loss or early on the gain, right?
Early on the game.
Early on the gain.
Both.
On both. Okay, yeah, because that's what I call trigger happy. You're just gonna, you know, pull the trigger very fast because you wanna, you know, you just wanna get out.
Cube, you kind of know this, but I'm a 2-contract kind of micro guy right now.
Well, that's another. Well, that's. I'm glad you went from 1 contract to 2. But that's another thing. The sizing down too much, you know, it can be harmful. But I do understand it. I'm not gonna shame sizing down, because the because there's a there's a place in a trading path, you know, on your trading career, where you're gonna focus more on the process than profits. And when that happens, you just buy even as well, not a single contract, you know. That's why I deviate from buying single contract sets, you know, or on futures or even options, because you don't get to experience the scaling out, at least, type of trading, you know, the scaling out. So uh so it's if you are in this in that part of your journey, I respect it very much. You trade smaller size, not caring about if you make money or not, and you just what's it called? You just focus on performance, and it's still a gain in my book. It's an unmeasurable gain. There's no way to you can put it in units in an account. It's not gonna buy you a pan of tomatoes, whatever the saying is. You know, it's just not gonna get you anything of money, but it is gonna get you experience for the later on. You know, so when you actually size on the market. Oh man, I'm feeling inspired. um, what else is next? What happened with my presentation? Okay. I went. I'm about to hit 3 fucking hours on this thing. God damn it. Um. Quick. I think we can set this for later. What do you guys think? We can do another session later.
Yeah, it's a lot.
Understanding options, you know, that's gonna be the Greeks, and that's gonna be very good for you, Jerry, that you do swings. Understanding the S&P 500 is gonna be good for you guys day trading futures and the and SPY and all that. Just to grab a little bit of context. This I'm debating this one, you know. That's why I'm stuttering right now, because this can be a harmful thing as well, you know. There's sometimes the price action only, you know, without context will give you a good results, and then you have context that contradicts the price action, and you'll go against what the market is doing, and that's a dangerous thing. So it does require you to be a little bit stronger mentally to deciding what's the stronger factor on the market. But I'll still show you guys setting up a watch list. You know, what I do homework every day. This is a good topic, but this is gonna require some time. And indicators, I'm just gonna throw it off. Don't use indicators. That's all I can say. Don't use indicators, guys. That was a topic. Completed. Done. Even though I have RSI right here. Just RSI, just, you know, there's a hit, like, look at this. There's a hidden divergence on Google. Bearish. But what if it does end up climbing higher, you know? Because you would expect about this high to be a higher RSI right here. So we're not getting it, but it's still, I mean, I don't know. The divergences can print and print and print, and then eventually it breaks down. We just don't know, right? So that is all. I'm gonna end it right here. 3 freaking hours. I hope, do you guys, I have a question. Do you guys take notes or anything? There's a video. I'm actually gonna stop the recording right here. Stop recording right here. Thank you for watching.